Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 256th podcast videocast for the week ending September 12th, 2024. A lot of great stuff to cover today, so we'll get right down to it. Family first, then business. Got to spend extended weekend Friday through or Thursday night through Monday in Orange County with the girls and my wife. They're out there training for water polo and swimming. Pretty exciting stuff, by the way. They're training with, we'll get into that in a second. So that's a picture, I believe, in Huntington Beach. And that definitely is the Huntington Beach Pier at night, which was a lot of fun. And then, of course, I did some channel checks. This was so wild. The culture of Vans. Now, in fairness, Huntington Beach is Surf City, so there's a lot of skateboarders, so everyone is wearing Vans, which was, very nice as a nice size owner of VF Corp. But it wasn't just that. They had Vans. I looked at this store. They had Vans on roller skates, and I thought this was just kind of like a concept until I went down to the beach and I saw people roller skating with Vans roller skates, which must just be a Huntington Beach thing, but I was pretty blown away. That's the girls at dinner one night. That's them doing their homeschooling during the day in between water polo and swimming. That's me at the Vans store in, I think, Fountain Valley. And I was talking to Star, who is an amazing host at the store, a worker at the store, about all this stuff. And she said that these new schools are selling so fast for back to school that they were actually out of stock. It sold so much faster than they could have possibly anticipated. They had to wait to get more in, and they did in time for school, and they were able to meet the demand. But she says these black and white new schools are through the roof. And then she went through a couple of the other newer ones that we've covered on past calls. And I said, she's been there for 4 years. And I said, so is this year slower than last year? She said, no, just the opposite. This has been the fastest, busiest 6 months since I've been here. It's really, really picking up. So, that's anecdotal, but confirmatory from what I saw in New York. This is Mimi with Maggie Steffens. She is 3-time gold medalist for water polo. She has the record for the most goals scored by an individual woman in water polo. That is an Olympic record. So she's training with her, and she's training with Tony Acevedo, who's a 5-time Olympian, was the captain of the Olympic team, silver medalist, and 4th in goals of all time for an individual in the men's sport with 61 goals during his Olympic career, which is just mind-boggling. Was also led the Stanford team to greatness, as well as I believe Maggie Steffens played for Stanford as well. So that's what they're doing out there, working hard. That's Annabelle goofing around with Caitlin on the baby set. They'll always be babies in my eyes. That's us at the beach, Caitlin and I. So that was a fun few days. I will be on Varney and Company on Tuesday morning, so tune in if you're free. Usually I'm on the 10 a.m. or 11 a.m. hour, right at the turn of the hour. And then I will be on Cavuto Coast to Coast on Wednesday, also in studio. So tune in at 12 p.m. for that. I've got a lot of stuff to cover today, so let's get right up to it. This is job openings. So all of this is pointing to job openings. We've covered all the data. We like to be data driven. Is pointing to the 25 basis point cut. The owner's equivalent rent, which we'll get into, spiked up again. So that's going to limit the cut to 25 versus 50, which I think is a good thing. I think if the first cut comes out at 50, it would spook the market a little bit. They have not set up the market for a 50. Timoreos has been talking 25. I think that's the way to go. And then maybe do 50 or 25, and then 50 right after the election in December. Get in 100. I think the market's pricing in 125 bips before the end of the year. That's probably too much. I think it's going to be 75 or 100, and all this points towards it. Job openings, inflation expectations. This was interesting. German factory orders unexpectedly increased for the second month. German's been slowing. It seems like it's starting to reaccelerate. And then you had the ECB also cut rates again this morning. So again, that narrative for international stocks starting to take the torch. I think we're going to see that not only in emerging markets in China, but also Europe start to see some level of outperformance. We've seen the green shoots with the UK in recent months, and I think we're going to see that elsewhere. Moving right along, we have S&P 500 members outperforming the S&P 500 in the trailing 2 months. That is getting back to the levels that we haven't seen since the early 2000s. And again, going back to 2001, which we've covered many times in recent weeks and months, as an analog, that's when you had emerging markets, small caps, value, and international and dividend pairs all outperform 2002 to 2007. So another confirmatory indicator pointing towards that. Leading indicators already troughed. This is a big deal. This is not the kind of thing you see turn up before a recession. It's what you see turn up after a recession. And we've been one of the few voices on the street that's been telling you since early 2022, when we had 2 quarters of negative GDP growth consecutively, that the recession everyone was waiting for already happened in the first half of 2022. And that's why everyone who was telling you about triple break putts and how the world was going to hell in a handbasket, and we were buying like it was going out of business in fall of 2022, when everyone was selling in the hole. This is why, ladies and gentlemen. So these are the type of data points that you see that don't point to a recession. If anything, they point to the beginning of an expansion, and those things that outperform, which we'll discuss. Each 1 percentage point change in the statutory domestic tax rate would shift earnings per share by slightly less than 1%. So this is what, in theory, if Kamala got in and increased the capital gains tax to 28%, in theory, you're looking at, 700 basis points decline of earnings. So you'd have basically your earnings growth would be cut in half for next year. That's assuming she could get it through, which again, what does the market like and need? It likes and needs gridlock. So regardless of who wins the presidency, whoever, as long as one party does not get the power in the House and Senate as well as the presidency, these type of dramatic changes are unlikely to be implemented. Next, let's see here. Expensive relative to the last 10 years. Those 2 groups that are the least expensive are S&P 400, which is mid caps, and S&P 600, which is small caps. So again, another theme we've been covering. This is the U.S. regime's heuristic. Value, small size, and high risk tend to fare well in a recovery. That is our base case. This is what it looked like in 2001, 2002. And what you saw in recency bias was the high quality, low risk, large size, i.e. Mag 7 outperformed phase 4 right before phase 1, where value, small size, and high risk really start to outperform. So I think that's where we are right now. You've seen the Mag 7 come off the boil a little bit. You started to see these perk up. I think after the Fed cuts, that's going to persist and expand over the next 12 to 18 months, and we're positioned for that. This also talks about relative sector and industry valuations, with energy showing the greatest upside on the basis of price to book. As a matter of fact, 3, price to operating cash flow, and forward PE. Those showing the lowest upside or negative upside. Information technology. All this data is from Bank of America based on data from 1986 to 2024. On a dividend yield basis, real estate looks like it has the most upside. On a buyback basis, financials look like they have the most upside. On a trailing PE basis, energy looks like it has the most upside. Least upside on a dividend yield basis is communication services. Least upside on a buyback basis is information technology. And least upside on a trailing PE basis is information technology. Enterprise value to sales, most upside is financials. Least upside is information technology. Enterprise value to EBITDA, most upside energy, least upside information technology, and enterprise value to free cash flow, most upside energy, least upside information technology. So across 9 metrics, what you're seeing is information technology having negative upside relative to 40 years of history. And again, we kind of have been pounding the table on this, and it's actually played out and will continue to play out. But what we've also caveated this with was this does not have to be 2000 to 2001 where tech would crash. It could simply mean they stop their relative outperformance and may have underperformance. So what does that mean in English? It could mean the indices are up 10%, Mag 7's up 3 to 5%, and some of the left for dead small caps are up 50 and 100% on an individual basis, and emerging markets and so on and so forth. So there's a lot to be said there. The yield curve is suggesting higher VIX for years to come. That is also an environment that we saw again in 2002 to 2007 when emerging markets, international, small caps, dividend payers, etc., outperformed. Tech, large cap growth quality dramatically underperformed. And that happens after periods when they outperform, and you can see it again, one more indicator. Chinese real estate stocks back to 2008 lows. That for me, and the last time you saw it before that was actually 2001. So I don't know how you look at something like this and say that this time is different. Like nothing, almost nothing could be worse than the great financial crisis, which was basically the modern day equivalent of the Great Depression, with policy tools that ameliorated the effect from a 10-year effect to a 2-year effect. But leaving that aside is those people who took advantage of those rare once in 100-year opportunities, made fortunes. Whether it was Joe Kennedy, whether it was the Rockefellers, whether it was the Vanderbilts, you name it, people who step in when there are these generational opportunities. Am I saying to go buy skyscrapers in China? No, your property rights might not be protected. But what I am saying is if you bought high quality, durable businesses in China, or the Hang Seng Index, for instance, which is basically Alibaba and Tencent as an ETF, you did extremely well coming out of these periods that everyone said nothing would change. As a matter of fact, a writer from Bloomberg asked me for my comments on it, and he was basically saying we've never seen anything like this. And I said to him, yeah, except for every 4 years for the last 25 years. And I sent him this chart that we've used in the VideoCast podcast a couple of weeks ago. And, the fact of the matter is it's China. So every 4 years, you see these once in a lifetime, once in a generation catastrophic crashes that always resolve to the upside. And this time will be no different. Whether it was 1995 and, you crashed from 14,000 to 6,000, 50% crash. And then you went up 200% from, 95 to 98. And then guess what? You crashed again, a 70% crash. This is the Hang Seng, which is basically China tech. And then from 98 back to 2000, you again tripled up 200%. And then guess what? You crashed 75% in 2000 to 2003. And then guess what? After putting in a 2-year base, you had the biggest rally ever, 4x, 300% over the next 5 years from 2003 to 2007. Then guess what? You crashed another 70% crash in 2008. Then guess what? You doubled in a half. This literally happens every 4 years. You can set your clock by it, and people are thinking this time is different. Look, it takes, with the exception of 2009, okay, 2008 and 2009, it only took a year to put in the bottom, okay? Every other time, it took at least a year and a half, 2 years, and the big ones like 2001 to 2004, 2003, it took 2.5 years. So we're on, let's see, 2020, end of 2022, and here we are at the end of 2024. So less than 2 years, and then sure enough, you get the recovery and things are off to the races. So this time is different. No, it literally 24 years. So you're looking at, since 1994, 30 years you've had this happen. 1, 2, 3, 4, 5, 6, 7, 8. 8 times 4 is 32. Every 4 years, the Hang Seng Chinese equities collapse more than 50%, and within the next few years, they go on to make new highs. And so you can bet that this time will be different. You can say, no way, I want to become a Rockefeller or a Joe Kennedy or Vanderbilt or anyone who took advantage and created these generational fortunes when other people were running for the hills because you're impatient or you're on leverage. But I just love seeing charts like this. This is why I skip to work every day. I literally feel like I'm going to a treasure hunt, and I'm looking for these rare opportunities where you can buy stuff, quality assets that are totally marked down right at or near the inflection. And at or near the inflection could be a year, it could be 2 years. Who cares when you're talking about double, triple, quadruples? The key is at the end of the duration, what was your IRR? And usually the longer it takes to build the base, by the way, this is probably the most important message of this week's call, is, where did I put that? There it is. The longest base that we saw was after the 2000 crash from 18,300 down to 8,300. So about 60% crash. It took from mid-2001 to mid-2003, so late 2003, so just over 2 years to put in that base. And then but because it was the longest base, you also had the highest recovery of 8,000 to 32,000, so 4x, 300% gain because the base took longer to build. And here you had the bottom at late 2022, and then the second bottom in early 2024. We have not retested that yet. So the bottom we believe is in. This is one of these fake out after the first move up. You get this check back like we had, and now a move higher. So we're in the middle of that recovery, and I think that's going to continue. So, and I think because the base took so long to build, I think we're on the cusp of one of the biggest moves in a reasonably short period of time. And I do think also it will probably be the last parabolic move in China based on age and demographics. Largest weekly outflow from energy funds since June 2023. I think that's signaling to us it's time to be looking more aggressively at energy. We are comfortable with our position with Comstock Resources. A number of you have been sending me some integrateds, but they've already moved so much and they actually haven't dropped in concert with the underlying. So I don't see big upside, but I am looking at some of the servicers. I am looking at some of the refiners and some of the more beaten down companies that have actually fallen with the price of energy. That could be potential opportunities in addition to Comstock. But I don't, with a concentrated portfolio, I don't really need or want 2 major energy positions, but I'll be open-minded if it's a fat pitch down the middle. bull bear indicator is not yet extreme at extreme bullishness. So that's why I continue to think it feels like it's been delayed, but now it's picking up a little bit of life. Is our expectation based on all the seasonality we've discussed in recent weeks, whether it's election seasonality, first cut seasonality, etc., was that we'd get some strength and maybe knock on the door to new highs prior to the first cut, suck everyone into the market, and then put on some tactical shorts in anticipation of the pre-election jitters from the last week of September through the last week of October. That may be actually playing out. We had a major reversal yesterday, bullish engulfing for all of you candle followers, if that means anything, that could yield that for the next 6 to 8 trading sessions into that cut, and maybe a little bit beyond if we get at or close to new highs. But as far as hedging out the book, I mean, everything that had froth that we made a lot of money in, we harvested, and we talked about that in late June and early July with Mag 7 before those rolled over, and the banks and everything else. So we'll look potentially to buy those back lower in October if the opportunity presents itself. This is an interesting, I don't know why this jobs report chart keeps repeating every single page. There must be some glitch, but this chart from Bank of America shows the divergence between luxury spending and lower income spending. So this started to diverge in 2023, and it shows how Dollar General has collapsed and Ferrari has gone to the moon. I think, and we're going to talk about some of these consumer discretionary stocks are getting exceptionally cheap and near inflections, and that's interesting because all the stocks that have been on my radar or that we have been able to take advantage of are oddly consumer discretionary because they've gotten extremely cheap. So whether it's not a position and it's on our radar like Lulu, which I spent some time at the store and watched my girls spend, I gotta be honest with you. I walked through Lululemon. There was nothing I wanted to buy, but whatever. I'm probably not their target market, but it really kind of felt to me, it felt like the Gap. I mean, the stuff seemed bland and boring and dull. Now, women will tell you, but and I'm just talking generally. I'm not talking about young people, but I'm just talking generally. Like housewives will say, well, it makes my whatever. It makes me look good, yada, yada. I don't know. They've acknowledged that they've got boring stuff. I think that's going to be an interesting turnaround situation, but I don't know if the margin of safety is good enough. Another one that's on my radar, again, consumer discretionary that's just gotten extremely cheap is Etsy. Again, I haven't done anything with that. Nike, by the way, I mean, I bought Vans because we own BF Corp, so we already have consumer discretionary, but I got to play Stanwich next week, which is like, for those of you who don't play golf, it's the best club in Stamford and in Connecticut and arguably like the East Coast. And Stanwich greens are so special and fast that I got a note like, you can't bring your normal spikes, even though they're not real spikes anymore. You got to buy spikeless golf shoes. So I went on and got these Air Jordans, which are sick, by the way. And what's great about these is when I go out to visit the kids in California, I can wear these on the plane and then go play golf with them. So Nike is putting out some really great products. I think Nike's more interesting. And the reason I didn't jump on it, one, I already have Vans, and two, I already have China exposure, which is basically what Nike is. But at some point, it becomes so compelling, we'll have to act. It's just not today. Next, August is surprisingly strong, but beware of September and October. So this shows monthly performance in election years from 1950 to 2023. September down 0.4%, October down 0.7%. And then you get a huge rebound in November, plus 2%, and December, plus 1.3%. Moving on, international price to earnings discount versus the United States. international stocks, all world country index, ex-US, is they're trading at 2 standard deviations lower than the average of its relationship to the S&P 500 PE ratio. So 2 standard deviations. That is an extreme. And what we know is that it runs in both directions. And the last time it got 2 standard deviations above was 2010. And what happened for the next 10 years? It dramatically underperformed the US. So when international PE was 2 standard deviations above its long-term average, the next 10 years, it dramatically underperformed the US. And now it's 2 standard deviations below its historic average. I'm willing to bet that the next 10 years, international, certainly the next 5, I don't really care about the next 10, international dramatically outperforms the US. And you're like, no way, US exceptionalism, blah, blah, blah. Look, I'm all for US exceptionalism. I'll wave the biggest flag on top of my house that you've ever seen. But when it comes to making money, I leave the idealism aside and I look to what the data tells me, and that's what the data tells me. So just remember, turnaround Tom's lesson of the day. When you buy a stock or a company or a concept 2 standard deviations away from its mean, if it's down 80%, 90%, if you buy it down 80%, it can go down 90%, which means a temporary 50% mark-to-market loss before it becomes a 4-bagger. And that's the difference. One of our quotes of the week is from Peter Lynch. The most important organ in the body as far as the stock market is concerned is the guts, not the head. Anyone can acquire the know-how for analyzing stocks, Peter Lynch. I have clients that call me and ask me, like, why do you share all of your ideas with the general public and your concepts? Number one is, I don't share all of my ideas, number one. Number two is, even if I did, literally I could tell people, I could have them watch me 24/7. And when they go off to do it their own, they're not it's not internal to them that they're going to have the temperament and the patience, because they're not really going to know what they own, and they're not going to really have all the inputs that lead to the steadfastness and the patience and the equanimity that comes when you have short-term price volatility. And even though you have relatively short-term business stability in most cases, while you have that price volatility before you get the big recovery, the big turnaround, et cetera. And we've seen it over and over and over now throughout the years. We went through a bunch last week. By the way, if you missed last week's podcast, I would definitely watch that first. If you missed 2 weeks ago with Brendan Ahern, I would definitely watch that first. But we do have a lot of good stuff that we're covering. So that's the theme here. Now, people are intending that the Fed easing cycle terminal rate will be at 290. I'll believe it when I see it. I think they might get down to 350 and be good enough there, because just as they're coming down, inflation's going to be more volatile than they expect. And we've been saying this for a while. They've got to let inflation run above 3% for 3 to 5 years to bring down debt to GDP. That's the only way they're going to do it. Just like they did post-World War II, when debt to GDP also ran 120% debt to GDP. Next, Chinese economy-wide prices in longest decline since 1999. So I guess a lot of people see this and they say, don't invest in China. I see this and I look at every single time you've had this level of price decline was a generational opportunity to earn outsized excess returns by buying Chinese equities. So that's just how I'm wired. And if you go back and you look at all these instances, you're going to see the exact same thing. Unless you believe day doesn't follow night and it will be night forever. So far, we just haven't found that in any instance of history. But maybe this will be the first time. But the way I always think about these things is the world only ends once, and if this is the time, you have a lot more to worry about than your stock portfolio. So I'll leave it at that. I mean, there's no way that China collapses and the rest of the world, you know, I had a friend who passed away, and he used to say, when the U.S. catches a cold, Europe gets AIDS. I mean, he was trying to get a point across. I think it's a similar situation. Yes, U.S. is strong to stand on its own, but if China really caught an aggressive cold, there's no way we don't at least get a flu in that environment. So the point is that these become opportunities. Day follows night, et cetera, et cetera. 10-year break-even rate is at the lowest ever at 2.0, so we know the cuts are happening. TSA passenger volumes continue to increase above 2019 levels. You can see the data here, well above it, and continue to do that. That's great for Boeing. That's the only reason I bring that up. China's CPI actually ticked up. That's looking less like deflation. So the year on year. Next is China's CPI year on year. Food is coming up. All these things are positive. That means their rates will start to come up. That means their currency will start to come up, and all the things that we want to see there. Percent of unprofitable companies. You know, the big case that you see people making against small caps is that, 41% of them are unprofitable. Well, that has always been the case right before they have their biggest rallies. Why? Because they do their best after the first Fed cut. And what that means is these unprofitable companies, the number one thing they need is cheap capital in the debt and equity markets. And that's a function of lowering rates. And that's when these things absolutely take off. So when people say, well, they can't do well because 41% are unprofitable, look at the last 4 times that they did well. You had instances where a higher percentage or an equal percentage in the case of the early 2000s were unprofitable, and that was at the beginning of the easing cycle, and then they took off while the large quality took a long back seat. Okay, Mag 7, we already covered that. This is from Matt Serminaro. I think he works for Tom Lee. Below are historical uninversions that have remained uninverted for greater than a year. I count 6 uninversions since 1976. Average 1-year forward total return is plus 16.6%. 4 out of 6 stocks ended higher. A more balanced picture for those saying the yield curve uninversion equals stocks are doomed. I agree with him. We've covered that on previous calls. And the most comparable example is when you had the Volcker error, just as where you had the most aggressive tightening cycle since we've recently had, and coming out of that, you had that uninversion that led to a multi-year rally. And I think we're having a similar situation to that. Where people get faked out is the last couple examples was 2019 before COVID and the great financial crisis. So they say, only bad things can happen. But what they're missing is the demographics in the background that are more similar to the baby boom we had in the early 80s that led to 20 years of prosperity versus the Gen X demographic pothole that we had in 2000 and 2008. My generation only has 65 million people relative to the boomers who had 80, and the millennials now have a big generation. So that demand, like you saw in the early 80s, is going to be similar to right now. So that uninversion does not necessarily mean bad things. As a matter of fact, it can mean very, very good things. Increase in volatility from July to November of presidential election years. And then it peaks in November and comes right back down. That's what we're seeing now. Yield curve suggests higher VIX for years. We covered that. Overweight consumer discretionary. Real wage growth is positive. Okay, so consumer discretionary companies like Vans, like Nike, like Lulu, like all these things. And even Amazon, I'll say, even though we took profits on Amazon because we had such a huge run from fall of 2022, buying in the hole, and March of 2023, we rang the register on that. But I think a lot of discretionary are going to start doing well against all consensus as these cuts kick in and lower people's interest rates and credit card bills and all that stuff. And the consumer is so relatively delevered from the great financial crisis. There's so much room for them to relever. It's astounding. Consumer discretionary has historically outperformed following the tightening cycles. Okay. And then you see discretionary versus S&P 500. You have the tightening cycle that ends, and then they start to outperform. And that's where we are right now. So we're going to continue to look for more opportunities in discretionary as well. We've already got a number of them. We've got Goose is a smaller position. We've got VF Corp. We've got a number of others as well. The destocking cycle, which has been the theme. Why has this been so important? Well, everything that we bought in the hole is working like crazy because the destock to restock, like your Generac up basically double off the lows, like your Stanley Black & Decker just coming out of the hole, etc. So we're going to see more of that. And believe it or not, we're going to see a similar situation in Intel. I know that one's a controversial one. We're going to cover a number of things on that this week. We did a major one on that about 2-3 weeks ago after the earnings call. So go back and look at that. We're not going to do a whole nother hour on that. Nothing has really changed other than that they're going to get a little liquidity. They'll sell off Mobileye. They'll sell off this other big and unnecessary division that was bought right before Gelsinger came in. They overpaid for both of them at $15 billion. They'll probably sell them for $7 billion, raise some cash, not do the German factory. All these other things will kick into gear. The government will be forced to give them the money that they promised them. And then all of a sudden you got a $30 and $40 stock. And then we figure out, is it really going to be worth 60 to 100? Or do we take the profits again in the high 40s and call it a day? We'll see where it is then, but I would not bet against it. So next, equity performance in different interest rate environments, international equities and value. Percent value, percent growth. Okay, so when you have a value international tilt, they do best in a 4 to 5% range. That's when they do best relative to U.S. equities. I think we're going, to 4 pretty quick, and whether we go a lot lower than that, I think remains to be seen. And if we do go lower than that, it will be over a longer period of time. So again, the next 12 to 24 months favors that positioning. Next is, now this is interesting. The August 2024 rent growth is slowing year on year according to Bank of America internal data. Yet the owner's equivalent rent spiked up this month. So again, that's a constant push and pull. We believe owner's equivalent rent continued to moderate after an unexpected rebound in July. It didn't, which is why you're getting 25 basis points versus 50 next week. Japanese yen continues to roll over. I think right after the Fed cuts, you're going to see the Bank of Japan hike, which is going to create a little more turbulence for the Mag 7 again in October. Why? Because the carry trade is going to continue to unwind, which was borrowing for effectively free and using that money to buy the Mag 7. So as the Bank of Japan hikes and people come out of that trade, the leverage is going to come out of the Mag 7. So I think we're going to see continued volatility to Mag 7 at least till late October. That is, I caveat that by, I think the next week and a half into the cuts, I think they could rip higher as a fake out. before this happens, and then they'll get back to at or slightly above highs, and then the Fed will cut, Bank of Japan will hike, and they'll roll back over. So just keep an eye on the yen is what I'm trying to say to you in a Cliff's Notes version. JP Morgan tempers earnings optimism, leading bank stocks down. So that was Jamie Dimon again talking about net interest income. We, as we said, got out of all of our banks. Those had huge runs, except for we did keep so we took profits on Citi and Bank of America. What we did keep is the regional bank KRE basket. We think that's going to continue to outperform, even though it's gone up a lot for us. These others, we'd like to buy back, hopefully late October, November, if they fall a lot, in anticipation of a 2025, late 2024, 25 investment banking cycle. But I don't think they're going to get cheap enough for us to buy back in. But my guess is we'll see 10, 20% pullbacks. But we had monster runs in those. So manufacturing is struggling to take off, but it's above that lowest decile where it got earlier in the year. Manufacturing headwinds set to ease with the onset of global monetary policy easing cycle. That's a big deal. And what you can see here, percent of central banks in easing mode, pushed forward by 9 months. Every time that happens, manufacturing turns around. Manufacturing PMIs follow that easing cycle, and this time will be no different. And there are a lot of small and mid cap in those buckets. X recessions, the first Fed cut has marked the trough in U.S. ISM manufacturing PMI. Again, we had two recessions in 2 years, 2020 and 2022. First 2 quarters of 2022, negative GDP, technical recession. This will be a cut into a non-recession. Even if you look at GDP now, we're nowhere near negative GDP. You would need 2 consecutive quarters. So therefore, you're going to see ISM start to turn up just like you do in the non-recessionary period. Manufacturing moves in sync with financial conditions. The outsized gap that has opened up is unsustainable. So you see this open jaw fish mouth. This will converge just as it does every time. The last time it got this far apart, you saw in 2002, and sure enough, it caught up again. The 2002 to 2007 period. Everything is syncing up. EPS growth projections continue to trend up across all regions. This is the Mag 7 again, earnings, just a reminder. And for new viewers, Magnificent 7 earnings growth collapsing from 53% down to 18% to down to 16%, while the Unmagnificent 493 from negative earnings growth to all the way back to low double digit 12% in the fourth quarter and beyond, double digits all of next year. That's why you're going to see a lot of those stocks left behind double and triple. Sentiment is optimistic but not euphoric, which is what leads me to believe we can have some strength into that first cut, and then from there get cautious. We'll see how that plays out. Bank of America analysts have been making the most downgrades relative to upgrades within staples. Staples are overpriced, by the way, and they've been making the most upgrades versus downgrades in consumer discretionary, where we think there's opportunity. Same as industrials and materials. So we got to pay attention to all of that. I think the staples and certainly the utilities trade, I think that's gotten long in the tooth in the short term. Discount retailers underperform luxury retailers when oil prices rise. So discount luxury year on year. WTI. So the implication of this is with oil prices coming down, we should be nearing, that's interesting. That's kind of like what you saw in 2009 and what you saw in 2002, similar situation. and then all of a sudden it reversed. So these, the Dollar Generals of the world and the Dollar Trees, I keep looking at them. I'm going to want to get involved in some way. I'm just not there yet. We're still doing work. Biggest surprise was OER inflation. We got that. Wage growth is improving across all income groups, with lower income households still outpacing other cohorts. So again, I think some of the issue, because if you look at Walmart, Walmart's had the trade down that's worked well, but their execution has been superior. I mean, you walked into Dollar General, it was just a complete, trash can is basically what it comes down to. So I think they'll fix their execution and they'll come back. Either them or Dollar Tree. We're looking at both. U.S. household income, that continues to rise. This is from Brendan Ahern. Yesterday, Baba, according with their Hong Kong filing, bought 5.6 million shares equivalent to 713,000 ADRs, which accounted to 6.2% of their ADR's volume. Worth noting, Tencent bought 2.68 million of their Hong Kong shares today. Meituan bought. I suspect many will look back in a year and say, how did we not see the signs? That's exactly right. I mean, that's the one thing I give the Chinese credit for. The U.S. managers, when Jensen Huang is selling $500 million of stock just as he splits the stock to the retail investors who got smoked down 30%, he announces a, $50 billion buyback to absorb his sales. And right when the stock is trading at 41 times sales is when he announces the buyback. The Chinese companies only do the buybacks when the stock is cheap. The Americans do the buybacks when the stock is expensive so they can lay off their own stock. And it's you just see it over and over. There are very few management that actually aggressively buy their stock back in the hole in the U.S. And it's a shame. So again, keeping an eye on this XLE to XPY ratio, getting towards an extreme. Chinese, we covered that with the prices. This is from Seth Golden. The current regime has been the worst from small caps relative to large caps since 2000. Again, going back to our same analog. But after that was a long runway of small cap outperformance. So you can see that here. Biggest drop between regional and large banks occurred, as you would expect, during the SB Silicon Valley Bank in 2023. Regional banks have underperformed large caps ever since, but that is the largest bullish divergence I've seen in almost any chart, as RSI fails to make lower lows, with relative performance making lower lows. The bottom for regional banks and large banks may very well have formed as regional banks versus large banks may very well have formed as rate cut uncertainty developed in June. Regional banks are likely gearing up for Q4 outperformance. And keep in mind, a lot of the regional banks are what? They're small cap stocks. So this is what he's talking about with the divergence, with the RSI going up, making higher lows, while the small banks relative to the large banks are going down. This usually precedes this, which is interesting that we kept our KRE and sold our C and BAC over the summer at huge profits. Okay, this is another one from Seth via Tom Lee. Mid-cycle rate cuts equals winner, winner, chicken dinner. After rate cut, S&P higher every single time, 1 to 12 months later. So what he's saying is, if it's not a recession, which we just laid out why it's not a recession, what happens 1 month out after the first cut equals plus 5.1% for the S&P, 3 months out plus 9.7% on average, and 6 months out 14%, with the 1, 3, and 6 month win ratio is 100%. So unless you feel that GDP is going to go from 2% to negative for the next 2 quarters, you want to bet on equities being up on a 1 to 2 months after the first cut, 3 months for sure, 6 months for darn sure, and it could be more meaningful than people expect. Average duration of a bull market not following a former recession is 33 months. That would take the S&P to May of 2025, and the average bull market gain for like conditions has been 63.6%, which would take the S&P to 58.52. But notice something else. If the bull market ended in July, it would be the shortest bull market in history, tied with that from 2020 to 2022. Question: do you think the stock market would suffer the shortest bull markets in history in back-to-back occurrence? Table informs that would be the lowest of all possible outcomes. The other thing I would keep in mind here is that here it's saying that it didn't follow recession. I would assert that we did follow a recession because we had that recession in the first 2 quarters of 2022, which wasn't declared an official recession, but it was a technical recession. Therefore, this duration should be not an average of 33 months. It should be an average of 61 months because it was preceded by a recession, and therefore the averages go and the gains go dramatically higher because the duration of the bull market is dramatically longer. Next, early stages of inventory building is typically a sign of recovery and or expansion cycle, not a sign of economic weakness or recession. This is another way to talk about the destock restock cycle that we've been pounding the table on for 6 months. And you can see here, he's referring to merchant wholesale inventory. This looks a lot like what? 2000 to 2002, right before you took off. 2009 to 2010, before you took off. And 2000 to 2001, as you were taking off. So, there you go. And I think we got to the last chart. Wow, that was a lot of data in a short amount of time. Moving along, we covered the quote of the week. Another one: opportunities come in frequently when it rains gold. Pull out the bucket, not the thimble. That's from Warren Buffett. And then PayPal. This is from Alex Chris. PayPal's largest marketing campaign ever, starring Will Ferrell. This campaign reintroduces customers to a whole new PayPal, highlighting how easy and rewarding it is to shop with PayPal everywhere, both online and in stores. This is Will Ferrell doing his best work and making people laugh and making people remember PayPal and PayPal's cashback rewards. I will not play it for you now, but you can check it out yourself. Sentiment came in a little bit. Bullishness down to 31%, bearishness up to 31%. National Association of Active Investment Managers equity exposure dropped down to 71.9%. Again, no man's land, not an extreme. I think we'll get an extreme before that cut. I'd love to see them get into the 90s or 100%. Alibaba merchants hail adoption of Tencent's WeChat Pay on Taobao and Tmall. So basically, WeChat has like 1 billion users in China, and now Alibaba's allowing them to use that form of payment on Taobao and Tmall if they don't want to use Alipay, which I think is a good thing, not a bad thing. PBOC considers 3R reserve requirement ratio cut ahead of U.S. Fed cuts. So, more talk towards easing. Alibaba yields good results from 3-year inspection, says regulator. They closed out the inspection that started the collapse 3 years ago, so that's good. Yellen says she would welcome a visit by her Chinese counterpart. That's good. China's central bank sees room to lower bank's reserve requirement ratio. They are now saying this could come as soon as September, which would be good, which is now. Alibaba looks beyond Chinese suppliers as additional tariff threat looms. So what did they do here? They're talking about AIDC growth of 32%, $20 trillion business. So they're growing super fast. So they can build another Alibaba on top of the Alibaba they have with the international in coming years. Alibaba join Stock Connect from Tuesday and potential 12 billion boost. It's now looking like more. Everyone's updating their estimates since the first few days of buying has been pretty aggressive. Alibaba logistics arm launches next day delivery in Europe, builds new hubs. This wasn't even part of their business years ago. Now it's going to become a major part of their business. Alibaba is battling with Temu parent Pinduoduo. Jack Ma says that's a good thing. Yeah, it walked them up out of their slumber. Steadfast, blah, blah, blah. So Jack Ma is back in the picture. That's good. Xi urges efforts to hit annual growth target amid rising doubt, 5% growth target. So they're going to probably juice the economy a little bit before the end of the year. China to cut rates on $5 trillion of mortgages as soon as September. Some banks are making final preparations for rate adjustments. Move may spur household consumption. So that's a good thing, not a bad thing. This is from Brendan Ahern, who runs KWeb, by the way. Mainland investors buy Hong Kong $3.5 billion of shares. Net of sales today, that's about $500 million of U.S. buying today alone. So what did they anticipate in the first 12 to 18 months? That it would do 20 to $40 billion of new buyers over the first year and a half. They've probably done maybe about $1.5 billion, $2 billion in the first 2-3 days. So that's moving right on track. Alibaba to benefit more from cross-border link trading. History of Tencent Meituan shows Tencent gained 23% in the first 6 months after joining Stock Connect. Remember, they just joined Stock Connect 2-3 days ago, while Meituan and Xiaomi more than doubled over 12 months after they joined the Stock Connect. So keep that in mind, ladies and gentlemen. This could be more meaningful than anyone even expects. Chinese chip making shows progress with new EUV patent from domestic lithography champion. Again, put on the tariffs. They figure it out themselves. Or the sanctions. Inflation rises 2.5% in August, less than expected. Intel is exploring the sale of part of the stake of Mobileye, as well as its network and edge business. So they're going to create some liquidity. And that's the key with these turnaround businesses, is the margin of safety has to be large enough that they have outs. They have things that they can sell to create the runway for their turnaround plan to kick in, just like it did with all the others that we've done over the last few years that you've been listening. This one will be no different. This definitely feels a little hairier, but when you're trading a tangible book and you still got, it's amazing how aggressively people talk like they're going out of business because they only did $52 billion of revenue in the last 12 months. I mean, when you got $52 billion coming in the door, you can cut a few jobs and you can sell a few non-core assets to live another day, to turn the corner, to catch the next cycle, and to have it double or triple in your stock over the next 3 to 5 years. And you don't even have to predict the future to get those type of results, but people are impatient and they can't handle the short-term volatility, so they sell their stock to people like me who step in and buy it. And then you'll see the activists come in and it will be off to the races. As an FYI, the board was meeting in the last couple of days, so I'm sure we'll see some announcements out of that in the coming week. Mark Cuban warns taxing unrealized gains will kill the stock market, insists Harris actually won't do it. I mean, that's kind of the craziest statement I've ever heard. If you're dating someone and they say, I'm going to kill you, but you kind of think they won't actually do it, do you keep dating them and ask them to marry you? I would say the answer is a hard no. The fact that they would have a thought like that seems logical from their framework of thinking, to me, is a non-starter. That is not someone I would trust with running a $7 trillion business called U.S. government allocations that thinks in that manner. So I don't really, want to spend any time talking about any social stuff. That's not that important to me, and it doesn't matter as it relates to the stock market. So you could talk about all the reasons why one candidate is better than the other for that reason. But with policies like this, whether or not they will be passed, the fact that they're even being broached and not thinking about second and third order effects tells me of the level of analysis of the close advisors of the people that are putting out ideas like this is not at the level that is currently sufficient. So either get new advisors and change your ideas, or hopefully it gets blocked. But it's interesting that Cuban was saying that, because he is a big time supporter of the people putting out those ideas. PayPal expands role in Shopify payments. What's in the cards? So they're just hitting on all cylinders. They're getting it done. Here's a quote from an analyst named Hutchison. If Intel can ride out the storm, it could reach a very profitable state in 2026 or 2027 if it succeeds with a new manufacturing process called 18A, designed to create the latest cutting edge chips. The problem is you have to wait till then. The problem with this analyst is he doesn't realize the stock market's a discounting mechanism. So if you get a little liquidity the end of this year, you get into 2025, when people are in 2025, they're not looking at 2025 numbers. They're looking at 2026 and 2027 numbers. So if there's a runway, the stock starts to price that in very, very quickly, which means 40, 50 bucks. And if they actually execute on it, it could mean 50 to 100 bucks. So we'll just have to wait and see how that all plays out. Intel Core Ultra 200V, aka Lunar Lake, goes official, takes on ARMS for the ultimate AI laptop experience. They control this space. 40 million shipped this year alone, better than estimates. It's going to continue to go. Here's the press release. Will Ferrell goes shopping everywhere in PayPal's biggest U.S. campaign ever. You should watch the ad. It's pretty funny, and I think it's going to be very memorable for people. PPI inflation data was tame in August. Lululemon is seeing a slowdown in its women's business. Has it reached a ceiling? The stock is definitely pricing in a lot of bad news. I don't know if it's pricing in all the bad news, but again, it just really felt like a gap. And Gap was big when I was young, and it's just never come back. I think Lulu can come back, but without Chip Wilson in the picture in a material way, I don't know. You know, there's a lot of competitors. Athleta. There's one with a V, Viola or something like that. Aloe. There's a number of them. We'll see what happens with that. I'm going to keep looking at it. Shelter inflation makes bigger rate cuts less likely. That's from Nick Timiraos, which means 25. Jobless claims inch up to 230, but still no sign of rising layoffs. We'll probably get that just after the election, which would imply 50 basis points in one of the November or December meetings. This is from Jacob Sonnenschein at Barron's. Consumer staple stocks are looking pricey. It's time to sell. We agree with him on a lot of them. Here's a hit piece on Intel, but there was one line that was useful. It says, Gelsinger insists the time to reap the rewards is finally arriving. Remember, his plan was 4 nodes in 5 years, and he's actually executed on that. So all the work and spend is largely in the rearview mirror. Now they get to actually reap the fruits of their labor. He says Intel's foundry business has engagements with a number of customers for $15 billion spread out over multiple years, et cetera, et cetera. So I think that'll be fine. ECB cuts interest rate. And article of the week, jackets and packets, stock market and sentiment results. We'll get through this and then get right to the Ask Me Anything questions. I thought this was going to be a short one this week, but didn't turn out that way. Where have I heard that before? Okay, so we wanted to cover Canada Goose and Baxter. Canada Goose, key points, revenues continue to grow, free cash flow recovering, margins are high, stock price subdued. Number 2, growing double digits in China. Asia Pacific is up 25%. A lot of that Asia Pacific up 25% are Chinese going to Japan to benefit from the currency weakness of the yen to buy Canada Goose in Japan to bring back to China. So a lot of this growth is because of China, and everyone says China is dead. Simply not the case. 3, in line with their long-term growth plan, they are growing direct-to-consumer and shrinking wholesale business to improve margins and the customer experience. Number 4, the non-jackets, their windwear, apparel, and footwear is up 20% year on year. So they're now moving to become an all-season brand globally. Very similar to what North Face did for VF Corp and others. 5, new sales training in key London store led to double-digit year-on-year growth comp within 45 days. They're now rolling that across all 70 stores. So keep an eye on that. And then if you just look back, step back dispassionately, what's happening? Revenues per share have just been going up every single year and continue to go up. Cash flow per share continues to go up. This was a softer year, 2024, but not relative to the amount that the stock price declined. It went from $50 down to $10 with flat for 1 year and now reaccelerating. So that's when you find your opportunities and that's when you take advantage. Share count's going to come back down. Overall sales continue to go up. And return on capital remains in the low double-digit range, which is good. You can go through this. Sales were up 4% year on year, which is good. especially with the quote-unquote weak consumer. Inventory came down, which is positive. They worked through some of that with sales. Mainland China was a highlight. We covered that. 3-point plan. They set their foundation for the next phase of our brand and product evolution. They hired this guy called Hadar Ackerman, who is a big creative director. So he's launching all this stuff like the hoodies and the hats and all the secondary stuff, the lightweight stuff. Second, implementing best-in-class retail execution. We talked about that with the training. And simplify the way we operate to become more efficient and more effective. They announced the layoffs last quarter. Strong gross margins continues. This year's gross margins are going to be in line with last year, which are strong. 65% plus. Just seeing if there are any key points that I want to cover here. Our in-season collection was a very positive development, which can drive the gross profit dollar growth in the long term. That will bring down margins. It's kind of interesting. It's kind of like PayPal. They actually increased cash flow, but the market sold them off because the margins declined because of Braintree. The key is their cash flow per share is going to continue to improve as they sell more products, even if it's slightly lower margin products, in addition to their high margin jackets. Their liquidity is fine. They've got $335 million of borrowing capacity. They always draw down this time of year in anticipation of the strong season into the holidays, and you can see it in their cash flow seasonality. All right, and that's that. Baxter International. I thought this long-term chart was pretty valuable. You've seen in the last 40 years that they have these massive drawdowns, basically every 20 years, like they had in 84 to 86, in 2002 to 2004, and to a lesser extent in 2009 to 2011, and then we just had in 2022 to 2024, and they always recover, and we're seeing this kind of inverse head and shoulders kick in here, which implies a measured move to 1356 in the short term, and the recovery will continue every time it goes back to new highs, which would be 88 plus over time. And they delivered. They sold off the kidney care business. They'll get $3 billion net after taxes and banker fees, which they'll use to pay down debt. And if you remember, our whole thesis to getting involved was that, when no one wanted the damn stock, was that they were going to separate the kidney care business, which was the slow-growing business, which was dragging the multiple that had traded at 16 was down to 10 times. And once they got rid of the kidney business, you would start to see in the next 6 months a re-rating of the multiple. So even without the business dramatically improving, just taking the multiple from 11, 12 times to 16 to 18 times on forward earnings, you're looking at, $45, $50 stock. And then as the business recovers and grows, it's going to go a lot higher over time, as it does every single cycle. So you can see the margin expansion, the operating margin, the earnings growth of 24% increased. So it beat guidance on both the top and bottom line. Grew sales 3%. They raised guidance on the top and bottom line. They got the sale done, which is what we talked about. They improved operating efficiency. They launched Novum IQ. They had growth across all their sectors. That was the key theme. Everything is hitting on all cylinders now, and they've got cash to delever back to investment grade, and they're off to the races. And this is why they call me Turnaround Tom, because I love these stories. I love buying them when there's hair, and then when they double and triple, everyone's like, how did that happen? And then they're all excited after they double and triple, and they're all buying zero-date options when we're selling out our stock, and everyone's excited. So pretty exciting to see all that. You can go through that. Fear and greed, again, this is not at a level where we want to be selling a lot. It's at a level where we want to be long. And think that's it. Earnings, the growth stocks, IBD 50, earnings revisions in the last 60 days for the top 30 weights went up 6% for this year and up 5.6% next year. So that's good. And materials also, materials are down 4.6 and down 4.18. So keeping an eye on that. My guess is that's skewed by one or two stocks because this is not a weighted list. This is just an absolute list. Just trying to see where that big hit was from. Looks like Martin Marietta is the culprit. So that might just be a discrete situation. Economic data, we covered most of this. Largely the inflation and the wholesale inflation came in better than expected. Jobs are a concern. Earnings estimates stay elevated, 15% growth next year. And now on to the Ask Me Anything questions from our audience. So for those of you who just like the podcast version, thank you for tuning in. For those of you who get value from listening to questions from the audience, here we go. Been great to receive so much stock information and opinions, not advice. Yes, as we always say, opinion, not advice. Go to hedgefundtips.com, click on terms, and here we go. Find the quotes of the day particularly beneficial. One you frequently mention is Buffett's, I don't look to jump over 7-foot bars. I look for 1-foot bars that I can step over. How do you reconcile that quote with your turnaround Tom investments? Intel in particular strikes me like it might be a 7-foot bar. So I would be interested in hearing your further thoughts. Greetings from Canada and thanks in advance. So Chris, for me, these are the 1-foot bars. The 7-foot bars are the ones where I have to predict the future and think that I know what the next new technology is going to be. In the case of Intel, if they liquidate tomorrow, I get my money out. If they live another day, I probably get double my money. And if they actually execute, I get triple to quadruple of my money. And it's just a question of waiting. So as long as I'm not on leverage, for me, those are the 1-foot bars, the turnarounds. As far as how I invest versus how some of my idols invest, like David Tepper, like Warren Buffett, like Charlie Munger, there is a difference, and you have to do what you're best at. And this is what I've found that I'm best at and superlative at over the years. And I'll continue to do what I love to do. I love the treasure hunts, and I love the things that are the 1-foot bars where I don't have to overthink it. I mean, I don't have to stay up all night wondering if Boeing's going to sell planes next year. I mean, it's a no-brainer. So if I own it at 150 or 160 and it goes to 130 before it goes to 350, I don't care. I'm not on leverage. And if it goes to 130 and if we have capital available, we buy more. So, Intel, if it goes to 15 before it goes to 50, I love it. If there's cash available, if there's new clients on board, we're going to buy more. I mean, that's just how we think. So these are the 1-foot bars. The 7-foot bars is what you all are doing, wondering if NVIDIA's growth rate is actually cutting in half now, even if they grow $4 billion a quarter. So the multiple is not supportive, and you wind up with these big 30 and 40% corrections, and then everyone gets out all at once, and you have another, Zoom on your hands. And I'm not saying that's necessarily the case with NVIDIA. It's a great company, but its price is what you pay, value is what you get. It's too hard for me to guess how many more suckers are going to come in and pay 80 times sales versus 40 times sales. That's the 7-foot bar, which I'm not interested in climbing. John Clark, I know you've been bearish on the dollar for a while. I'd say bearish and right, by the way. What are your thoughts on the euro over the longer term? It's going up. Euro's been in a range for almost 2 years. You think it can get above 112? Yes, and a lot higher. I mean, how far do I think it run? It's going to run to 137.10. I have no idea how far it can run. I mean, it's just a theme. It's it's the wrong question. If you get the theme right, you can play equities in such a way that you can make fortunes. If you get the theme right of weakening dollar and what the impact that has on international stocks, and then you get a couple of the turnaround international stocks on top of it, that are high quality where you don't have to guess the future, you can make 6x even if the euro only moves 12%, versus trying to buy options on the euro, which maybe it only moves 15%, and you could have made 300% buying 3 or 4 international stocks. That's the way to think about it. So I don't really care about a particular level. I don't think it goes all the way back to its all-time high, but it wouldn't surprise me if it gets in the neighborhood. Bob Johnson, can you take a look at Badger Meter, ticker BMI? Okay, let's have a look. BMI. You asking me for a short or a long? I'm assuming you're asking me for a long. And I'm also assuming you're pretty new to this podcast. So look, everything's going great right now. What do they do? My guess is everything's going great and it's mostly all priced in. So for me, it's a pass. But let's take a look. Seaport initiates a buy at $235. Where were they at $30? All right, let's see. 52 times PE. 10 times book. Let's see here. Yeah, I mean, look, this is a great business that will continue to go up over time, but I think you're at an extreme right now. It's got to rest for a while. Let me just take a look here. So it's trading at 7 times sales. Not bad, but not great for a boring business like this. 52 times earnings. What's the earnings growth? Yeah, you are trading at like a 2.5 to 3 times the earnings growth. Yeah, I think it's priced for perfection. Like if this thing pulled back 20 or 30%, I'd take another look. But it's a great business. It's priced like that. A great business. I need this thing to drop down to 160 to take a look, and it may never do that. But that's not for me. One thing I can guarantee you, I'm not getting a double on it over the next couple of years, so I'm not interested. All right, Max Moore. Do you have any thought on VLTO? It's interesting. I'm getting a lot of companies that have already had multi-bagger moves. So this thing is up. It's doubled in less than a year, and cash flow is rolling over. So my thought is not for me. Water treatment, blah, blah, blah. Yeah. Let's take a look at some of the financials here. Revenues are pretty slow grower. What's happening to earnings have been declining. Multiples. 5 times sales, 30 times earnings with very slow growth. No, this is a promote. I mean, it seems like a quality business, but let these guys get washed out and then look at it when it comes down by like 50%. Okay. Here's one from an anonymous person asking about Bath and Body Works. BBWI, another store that my kids like to shop at. It's down. I mean, it's still up 5x from the COVID lows. I generally don't like this type of business. We've seen it too much before. They had that Bed Bath and Beyond, which was a little different, but then they had another one that was just like this called Bath and Body Works, I think, or not Bath and Body Works. Oh man, I don't know. It was one of those stores with the candles and the soap and all that stuff, and it was just a fad. This looks like, I don't know what this revenue drop is. They must have sold off a division. Their margins are declining. Their revenues have been flat. I don't know what's to really like here. Cash flow has been declining. Let's see what else we got here. Yeah, I know. Let's see here. So revenues have flattened out and are declining. Earnings are declining. And the thing about it is the stock is only down 40% after being up 10x, or call it 9x, whatever. 10x at the peak, 9x at the recent peak. Taken their debt down a little. They've taken their debt down a bit, but let's just see their balance sheet. They've got $1 billion of cash. So their multiples are cheap because the business is declining. I just don't think there's enough upside relative to the downside. I mean, like, this is a trade that if you get it right, it goes to $60 in a couple of years, but like, if these revenues continue to decelerate, a stock like this could easily fall back to $15. So I don't really have any edge here, so I'm gonna pass on that. But yeah, generally don't like that type of business. Seen too many fail. Yankee Candle Company, all that smelly candle bullshit. It comes and goes. Smelly soap. You know, right now, Sephora, like, my kids spend so much money on Sephora, it's crazy. Number one, they shouldn't even be wearing makeup, but, you know, I'm outnumbered here. I got 3 women to 1. They're going to do what they're going to do. But that's LVMH. That's kind of interesting because that's been in the can because of China weakness, and that's another one we keep our eye on because China's going to come back and all these things are going to come back, Hermes, and so all, again, consumer discretionary. All right, this guy's asking, Peter Webster's asking about Mexican TV Group. This is a cheap stock. I think you won't get hurt with this, but it's television and it's not where money's going. It's where money's going away from. Cash flow is recovering. Their revenues have been declining. Their margins have been declining. I think this is a trade. I don't think this is a business you want to own for a while. I think it's, you know, I think you might get a punt back to $7 or $10 if you're lucky, but that's speculation. I'm not really interested. That's a secularly declining business. Toma Fisher. How do you allocate your time between studying businesses at the micro level and following the market as a whole? You often mention indicator sentiment, seasonality. Curious how this helps your strategy and how you divide your research time. I don't have a framework for dividing my time because I don't think about it like an employee, like, oh, I'm going to do 8 hours today. You know, some days I do 16 hours and some days I do 6. I mean, but I'm always thinking about all of it all the time. And it creates, I take in as much data as humanly possible. I mean, the amount of companies I study that I will never put $1 into are staggering. and they're on purpose, because the things I hear in certain earnings calls and read in earnings calls transcripts cross over to businesses that I do hold or would hold or avoid or don't want, and for particular reasons. So I do it all. That's the simple answer, Toma. I don't think about it as fixed time. I do three things. I do family, I do work, and I golf. And beyond that, I don't do anything else. So they're all interrelated. When I'm golfing, I'm talking to business people and finding out about the economy. When I'm working, I'm just doing what I love. It's a treasure hunt. And when I'm with family, I'm just enjoying that. So that's all I do. And then finally, another anonymous email about HelloFresh. Someone asked me about what was it? Grab Holdings, I think, which was anyway, HelloFresh. Look, this is cheap. I think that business is not the business I'm interested in. Someone asked me about the one that has Factor. I think this is actually rear view mirror, not just because COVID is over. Oh my goodness, we got more questions. Okay. But because the demographics, so part of the reason we own a lot of things we own is because the bulk of our population is 33, 34-year-old. Similar to China, by the way. And they're moving from getting these single things in the mail when they have an apartment and popping them in the microwave to going to Costco and buying, 20 pieces of chicken for $20 to feed 2 or 3 kids. They're in the baby creation stages. And when you're in the baby creation stages, you're not ordering 1 serving for you or 2 servings for you and your wife. We did that for a while. We got like 3 microwaves. It was the stupidest thing ever. Like we all did a lot of stupid things during COVID. But I think this is rearview mirror. Now, you could say it's a cheap cigar butt and they're going to continue to do fine. I'm going to say I just don't want to be in the space at all, no matter how cheap it is, even though cash flow is recovering, even though revenues are high and flattening, even though margins are kind of holding on but declining. I want nothing to do with it at any price. I can't predict the future, but I don't like the business, whether it's Blue Apron. So many have gone bust, and you could say, well, it's just this one and the other one that has Factor that the other guy sent in last week, and they'll be the winners. I don't think any of them are going to be winners. I think people are going to go out of their house. They're going to, if they don't want to cook, they're going to buy that, go to Whole Foods and get that stuff at the buffet. And most people want to go out. And if they're in family formation, they're going to start going to Kroger's and Albertsons and Walmart and Whole Foods and Costco. So for me, it's a pass. I understand why you got there, and the framework is correct. I just think secularly, it's not something I want to own. I think it could work as a trade because it's so cheap on every single metric, and I can see what got you interested, but it's not for me. Jim Jones, what's the difference between holding New York and Hong Kong shares of Alibaba? There's no difference. The only reason we own some in Hong Kong is because there was a period of time about a year ago where there was a serious possibility that they could be delisted from the U.S., so we didn't want to deal with that risk. And since then, the PCAOB gave them the green light, and so now it really makes no difference. So I'll leave it at that. John Silva, would you average up your VF Corp position after seeing the stellar execution for Bracken Darrell and the team so far? I never average up anything. I never buy up. I buy down if it goes against me, and I expect to buy down after I initiate a position, but I would never buy up. VFC, it's just starting here. It's up from whatever it is, 12 to 17. I think the upside's a lot higher. Bracken Darrell created whatever it was, a 20 20-something bagger in a few years with Logitech, and that's a commodity product. I mean, Vans and Timberland and North Face and Dickies, these are all kind of sexy brands that you can do a lot with. I mean, a commodity video camera is nothing sexy, and the guy turned the thing around and had a multi-bagger. So this thing could, I don't know if it'll go to new highs, but it wouldn't surprise me if it went to new highs over the next 5 years. But we're certainly going to get a multi-bagger out of it, and we'll look at the fundamentals when we get to our initial target for intrinsic value based on what they're doing. We're not going to new highs with Vans doing down 20% every quarter and him getting on the phone and saying, we're doing better. We're down 20% instead of 21%. Like, you know, that dog don't hunt. But that's part of the turnaround process, and we're understanding of that. And based on the indicators he shared with us and some of the things that we're seeing, we think that's going to be temporary. And in which case, there's a lot more upside, and the ride has just begun. So, no, I'm not giving you my predetermined exit for our first tranche. That's to the benefit of my clients. But I will let you know when we're out. And in the meantime, you shouldn't be in unless you've done your own homework. So we'll continue to update you on that. We'll on our thinking around it as they report earnings, just as we did 2-3 weeks ago. But I think the upside is enormous. And we're really betting on the horse here. And that's something we love to do, if you notice in our turnarounds, is bet on the jockey. Even in the case of Advanced Auto Parts, which has been a shit show, Shane O'Kelly is doing everything he said he was going to do. And we feel very good about what he's doing. Now, could we have done without the soft guidance for the next 2 quarters? Of course, but Disney had the same soft guidance. It is what it is. It's the lower-end consumer. But he created the liquidity we needed to take solvency risk off the table, and he was very successful with the Worldpac sale. And now he's executing the way he did at HD Supply, which was a $7 billion business for Home Depot that he absolutely shot the lights out with. And he's going to do the same thing with Advanced Auto Parts and turn it into a very nice, very profitable business that's growing 100 stores a year and doing it in the right way and servicing the professionals as well as the DIY, blended box, focused business, no distractions, and this thing will turn around and become a multi-bagger over time. Right now it's trading like death, but that's what they do. You know, they go against you before they double and triple, and it happens every single time. If it was easy, everyone would do it. Simple, yes. Easy, no. And that's where our value add is. And that's how it works. So, Alios Grabber, thanks for the great content. Been listening for a year. Appreciate it. Beginning my studies in economics. Career advice or recommendations. Go to the YouTube channel and the Hedge Fund Tips YouTube. So just go to YouTube, type in Hedge Fund Tips, go to the channel. Then you can search in the channel, put in University of Bristol. I do an interview with this lady who ran the investment club at the University of Bristol. It's about an hour giving advice for anyone who wants to get into the business, what they should do, and how they should do it. Jack Monato asks, Tom, can you please let me know what you think of Volkswagen? Seems undervalued to me. I would never buy an OEM. Let these guys kill each other. It's going to be a race to the bottom with pricing and incentives in the next 2 years, and volumes are going to go through the roof. Which is going to help Cooper Standard. So I know they're cheap. I'm not interested, whether it's Ford, GM, Volkswagen, Toyota. You can have them all. I just want to supply I want to be the arms dealer. And as they cut prices and increase incentives and volume goes through the roof, we will make tons of money on more volume with huge operating leverage with Cooper Standard. So we're in the sealing and fluid transfer, fuel delivery businesses and the top, and we just want them to sell tons of cars. We don't care at what margins. We think their margins are going to go down and their volumes are going to go up, and our volumes are going to go up and our margins are going to go up because our operating leverage is incredible. So with that said, we'll see you next week, same time, same place. In the meantime, make it a great one. Bye for now.